everybody. Thanks for joining us again on the Alex Hayes podcast. I am your host, Alex Hayes. Joining me today are my very special guests, Dr. Art and Sharon Harrington from Harrington Financial Services. They have been enrolled agents and helping people with taxes and tax strategy for multiple decades. They at one time had the largest tax preparing agency in Arizona, doing over 6,000 to 8,000 returns a year. And today they are here to share with us their wisdom and insights of building a business, but then exiting their business in a way that allowed them to live the life that they wanted and to preserve their legacy along the way. So with that, Art, Sharon, thanks so much for being here today.
Glad to be here.
Appreciate it.
Yeah, absolutely. I guess my first question is take us back. When was your company founded, and why did you start?
Well, I had begun the company back in about 1980. Yeah,
I did it.
1987.
As Leadership Incorporated consultants, and I was working with churches, Christian camps, other groups, nonprofits, and then when I married Sharon in 1990, she was the tax expert, and at the time was the regional director for H&R Block for the largest district in the country, and one of their top national trainers. And so I wound up learning the tax business, and she decided she wanted out of corporate leadership and into having her own office. And with my doctorate in administration and everything, I couldn't imagine doing one of anything. And so we began building a kind of a tax empire and acquiring different franchise offices. We began putting offices together all across the Navajo Reservation in Arizona, and eventually had offices in other parts of the state. Eventually wound up leaving H&R Block from being the largest franchise tax owner in the state to becoming the largest independent tax service. And we've always had a kind of a three-legged stool, because Sharon has a master's degree in business law and accounting, and is a national business accountant, a specialist, and I am a financial advisor, among other things, and then also an enrolled agent now in the Treasury Department. So I do tax representation work as well as taxes. So we've had all three of those things, the financial services, the accounting, and the taxes under this corporation. And so that just moved right into the corporation. We eventually became known as Harrington Financial Services instead of Leadership Incorporated Consultants.
What was the spark? Again, like Sharon, for you, what was that real spark? Why did you want to get out of corporate and start your own? What made you want to get into this as an independent?
I had been working for H&R Block for over 25 years.
Oh, wow.
So, and I was then currently the franchise director for Northern Arizona. And I had like 35 or 36 offices that I traveled around to. I was tired of driving, and the company, Henry and Richard, that started the company, and their son Tom, that also was pretty high up in the company, they had given away or sold or whatever they did the leadership of the company, and they went a different direction than what we had for 25 years. And so I decided I just wanted out from under the corporate thumb, so to speak, and I wanted to get my own office. And so actually what we did was we bought one of my franchises and became an H&R Block franchise, self-employed. You know, we weren't working for Block anymore. And so we had to pay them a great deal of money every year on what we collected through their programs. And so eventually, you know, we just decided we wanted to get out and get totally on our own. So we did that.
That's awesome. That's awesome. So it was wanting to kind of chart your own course and have more decision-making autonomy.
Right.
Yeah.
It was that, and we wound up with the new management. They had different business ethics than we did, and we had some conflict over that. And I decided it would be better if we could do what we believed was right and operate our business in the way that we felt was important. We wanted the trust of our clients and to be able to deliver what we promised. And so that was something we felt we had to do on our own.
That's awesome. And great reason to start your own company. It's out of the desire to help people and to bring people value. And if you see something, you see a wrong that's being done and you want to do it the right way, I think that's a great a great reason to start a business. I'm spending just a few minutes on the genesis story of Harrington Financial so people can kind of get to know you guys a little bit more about where you started and how you grew your business a little bit. But before we kind of jump into some of that exit strategy stuff that I'm excited to talk about. But what were some of those early strategies you said you purchasing a H&R Block franchise and then you started your own
We
independent.
had additional franchise offices and so forth. And along the way, we had diversified, and we decided to get into also some mortgage stuff. And Sharon got qualified in that area, initiating mortgages. But again, we wound up deciding this was not something we could really deliver to our clients what we were promising, because we didn't have that much control over when and how the financing would occur. So we exited that.
Mm-hmm.
And so, we poked around. We also decided, because we were not having in our location any news coverage of the events, the Rotary things were happening, the fine arts and all in Apache County. So we decided to become newspaper owners, and we owned for about 5 years the Apache County Observer. We learned the hard way that you can't survive in that business on subscribers, although it was a very popular newspaper. It takes advertisers. And Apache County was the poorest county in the state. We didn't have enough advertisers. And so after losing about $50,000 a year on that, Sharon says, we don't think we can continue to provide this community service that much longer. So we exited the newspaper business. But that was always, the side business of the things that we were doing as far as the tax, accounting, and securities. So we continued our main business, and we continued that. But then at some point had to realize that we built a monstrosity here. People would look at us and ask us, how many taxes returns you do a year? And I would say 6,000 to 8,000. They say, are you crazy? And my concept was always, we'll have our youngest son and his wife who were working with us, that they would take over that. And then we would just kind of step back and hand select the clients we wanted to work with and work with them. And then one day my son and daughter-in-law came into the office and said, Dad, we really don't want to live on the road like you do, managing a dozen offices. And we just want one. And so we wound up, at the time, Sharon was having some serious health issues and couldn't be up there at that 7,000-foot elevation any longer, where our main office was in Springerville and northeastern Arizona. So we wound up giving that offices to our son and daughter-in-law. And then we began looking at, okay, what do we need to do to get to where we want to be? We have a business that isn't easy to sell, because you've got to have certain qualifications and licensures and all. And nobody really has all three of the areas that we have been doing to be able to sell the whole business. And so we wound up deciding we'd have to downsize in pieces and parts. Some offices weren't that profitable, and we decided we'll just close those because they were pretty much seasonal offices. And others, we decided the best way to do this is to work with our managers and sell them these offices on a 5-year contract. We were seller finance on it, and we would also, along with that, agree to do consulting services for them to help them succeed. So that's how we began downsizing to get to the point where we finally are doing what we want to do.
So before you got to the downsizing, it's just a couple, maybe an overview, broad, big picture. How did you grow a CPA office to 12 locations and doing 6,000 to 8,000 a year? Like, talk to us just briefly about what that journey looked like, and then how did you do something so extraordinary?
Well,
Go ahead.
To start with, when we decided to leave H&R Block, the 4 of the offices that we opened under our own business had been my franchises that I had worked with when I was the district manager for H&R Block. And so those businesses also moved away from H&R Block and came under our name, Harrington Financial Services, and they operated like that until they bought their office individually. And so now we have 4 owners on the Navajo Reservation that used to be my franchises, but we still work with them several times a year on consulting and things like that. And so that's how we happened to get the offices on the Navajo Reservation, is they were my franchises originally, and then they left Block as well and came with us.
But the way we grew those was really concentrating on delivering a quality product, making certain that our tax preparers, our managers were well trained. I did a lot of training every year, and making certain we delivered what we were going to. We promised we'd give them quality service. We'd give year-round service that they could call in to us, and we'd work with them. And so that was really the way that we grew the offices, growing by delivering quality service. At one time, we'd owned the office in Holbrook. In fact, that was one of the first ones that we
It
had.
was.
And we wound up, it was a part-time owner from California, really, that owned it long distance. So by developing that into a quality office, we wound up quadrupling the volume, and then wound up selling that to our manager. So over the years, that's been our formula. We deliver everything we promise, and if there's something that's out of line or wrong, then we make it good. I had noticed in one of our offices, for example, when I was out managing the offices and looking at the charges and everything, I discovered that in that particular office, there was a computer glitch, and we were overcharging our clients by $20. Nobody ever complained. Nobody noticed it, but I did as the owner. And I said, this isn't right. And so I wound up fixed the problem with our program. And then I mailed a letter of apology to the clients, and along with a $20 check, and said, this isn't the way we do business. And so here is your refund. And so it was that kind of building of a confidence in who we are and what we deliver that I think caused us to grow.
I think that's excellent. And there's so many people having manpower problems today, staffing problems today. What would you say was your key to success? And you said you mentioned a lot of training, but talk to us about what that looked like and how you found qualified, like where did you find these qualified people? How did, were they, did you find them off the street? Did they come out of high school, college? Did you have like a training, like a structured training program, or was it one-on-one? Like, how did you make sure that 12 offices had fully capable and qualified staff to do that level of returns?
In most cases, we were working on networking with the existing employees and other people we knew in the business that knew somebody that we contacted and asked if they would be interested. Didn't do a lot of advertising out there just off the street, because most of the people would not have the qualifications and background. But for example, we owned a houseboat on Lake Mojave, and we'd bring our clients, our tax preparers, over there and do training on the houseboat and take them out on the lake, and they would enjoy that. We tried to give a few extra little perks along with what we're doing to help build the loyalty. It was really kind of interesting, because we came to our managers who are trying to downsize and said, okay, we'd like to sell the business to you and work with you on it. We'll carry the financing office out there. They said, oh, we just want to continue to work for you. So we had built that kind of relationship that they said, we like working for you. And then we finally had to go back to them and say, yeah, but we really don't want to continue to own it. And the manager wasn't that confident. And so she wound up actually bringing on her, going to her top preparer and said, would you do this with me? And so they wound up in a multi-party LLC, taxed as a partnership. And we worked with them in that. So different scenarios, but we really tried to build relationships with our employees. We became friends and family. And so this was something that I think was very important.
Interesting. I think that, how did you go about determining who you were going to bring into the family? Like, what were some of those qualifications or those markers that you looked for somebody that was going to be a good hire for you?
We're looking for people who were honest and ethical and were hard workers, would be,
Experience.
well, if they had experience, most of them had to be trained. First year of training a new preparer in the tax business, I'd say they're hardly worth the powder to blow them up, because all the book learning doesn't make a whole lot of sense until you're actually sitting down and working with a client. And so it was living with these people and answering a lot of questions and working with them over a period of time to develop them into good, solid preparers. But there were people that along the line we found really weren't that dependable and weren't the people we wanted to have. And so we found some other people that would be. And so we needed to have a team that we could trust. We couldn't be out there in all these offices all the time. I did a lot of time traveling and working with them, but we had to be able to trust them to be able to do what was right and not to be taking funds from us on the side or we just had to trust them.
Yeah. Sharon, from your perspective, what was some of those keys to success that you were looking for?
I was looking for experience and training. I was a training officer for a long time for H&R Block, so I was experienced in doing training for taxes. And so I was just looking for people that could do the job as well as trustworthy and client-oriented. We actually sold one office where the current owner is not client-oriented. They're not open very much after April 15th, and they don't respond to client calls and things like that. So it's that kind of thing that we don't want to work in our offices, basically.
So high touch, you guys had a particular type of culture in your business that you wanted to make sure was propagated throughout every office to make sure that you had a consistent deliverable.
Right. We wanted the name to mean something. When they saw that name, they knew that it was someone they could trust. They would do their best. They would deliver quality, and they would back it. And we had a guarantee that if we made any mistake on a tax return, we would pay the penalty and interest charges that would be involved with that. People still owe the taxes that they owed, but that was our guarantee, and we always kept that. We didn't have to pay it very often, but occasionally mistakes get made. And so when there was a mistake, we said, it's our mistake. We'll pay for that.
Interesting. That's awesome. How did you build this company from a structural, standpoint? Was it each office was its own LLC and you had a holding company, or was it all under the same umbrella? Was it how did you go about building the structure that supported this business?
It's all it was our corporation, and they were simply office locations. They did not have a separate entity for them. And so when we sold those locations, we were basically selling the name, the equipment, the client list, because we did not own the buildings. We were leasing in all these locations. They were simply our offices out there. They did not have a separate entity.
So you structured it as a S Corp or a C Corp?
C Corp.
C Corp. What were some of those? What were some of the planning things that you had to put in place when let me back up. How many years before you started selling off the pieces did you start to prepare for these events?
We really didn't start preparing for that until Sharon developed health issues, and we discovered that the son and daughter-in-law didn't want to take over the mega corporation we had developed. And so that was when we then had to sit back and look at, how do we begin downsizing? And that was probably in
1998 when Jackie and Brian said, we don't want to do this anymore. It was when you were the district governor.
So anyway, we started then looking as to when we approached these different owners or managers about becoming owners. And so it didn't happen overnight. It didn't even happen in a year or two. It was something that we just one by one, as the timing was right.
Interesting. So your exit per se, because I know you guys still have your business and you have your select clientele now, but your exiting process of the major corporation was, maybe was it over a decade period that you started? Was the transitional phase?
We started that in 2005. But that was just the planning stage. I believe the contracts were in 2014. So that was like 24 years after we started our own business, but we didn't actually totally exit our actual offices until then, 2015.
Awesome. So you had, it was about a 10-year period of transition. And so when you were looking at your strategy for exiting, what were some of those key pieces that you included in your thought process that people should be aware of? Like, how did you do it? How did you approach the strategy of exiting?
And we decided, first of all, that it wasn't going to be something. We talked with different brokers and all. It really wasn't going to be a buyout. Somebody was going to come in and just buy us out. So that was when we decided that we're going to have to do seller financing with our managers. Were the best prospects to be able to do that. With the last office that we had owned, the physical office, we actually brought in somebody and had them work in our office for several years as tax and accounting manager before we proposed then that he purchased this from us. So each of the offices was a little different. And so we had to evaluate, who do we have here? And then, like the one office, the manager said, I don't feel qualified to do this. And so that's when she began, and we talked with her, well, who else could do it with you? And so her key preparer agreed to do this. And so we just had to kind of adjust it to whatever we had there to figure out, okay, how can we make this work? We know we want to be out of this location and downsize, but we don't want to give to the wrong person. We don't want to do it in a way that we're going to wind up getting this back because in so many cases, when you are doing seller financing, that's the biggest risk. They're going to get it back when they can't afford to pay you off. And we didn't want these offices back. We were trying to downsize. So we wanted to make sure that whatever we did was going to be a formula for their success. And so that was one of the reasons we included the consulting to help them.
The one preparer that we sold the office to, it was our biggest office on the reservation. And she had actually been my employee at H&R Block for like 20 years. And so she was well qualified. She went to training every year for update training. And so we just knew that she could do it if she had somebody to back her up.
And we have continued after they went up paying off these offices. We had the option that they could purchase a contract with us each year to continue on consulting. A week doesn't go by having a call from one of the, or more of those, particularly during the hectic part of the tax season. I will have multiple calls every week from them with issues that they run into that they're not familiar with or they don't do all the time. And there were some pretty interesting tax questions out there. And so that's my job. It's part of our contract to do whatever needs to be done. If I have to research a particular issue or whatever, to get back with answers for them and help them, because their success is paramount. We feel an obligation too. Those were our clients for a long time. We want to make sure they continue to get the quality of service that was associated with our name with their new owners there.
I think that's awesome. So you have a goal in mind. So you look at it, okay, we need to downsize. You first evaluated the marketplace. Who's a qualified buyer? That was your first question, right? And so you went, you sought out some answers from brokers or some other people and try to see, what path is going to be the best way to exit this? And you started with who's going to be the buyer. And then that led you to, well, it's going to be very difficult to find a corporate buyer that's going to buy the whole thing. And so it'll be much easier or more controlled if we sell each office individually and structure these multiple different arrangements for our benefit. And I, correct me if I'm wrong, but it sounds like you maintained a lot more control that way of the process.
Yeah. And one of the things that was evident in talking with the brokers, most of their people that were looking to buy a business were looking to buy a business at a location with a fixed market and clientele there. And they would kind of freak out with the idea of all these different offices and these distance places. That just wasn't the usual product that they were selling. And so it became apparent that most people were not going to offer us what we needed to get out of this to be able to make it work.
And Talk to me, and you bring up a good point right there. Like, you needed to get something out of this, right, to make
Right.
it work. How did you go about, talk to me about that part of the planning process. How did you go about assessing what it is that you guys needed in that exit as far as dollars goes on the other side to plan for your, post-exit lifestyle? What were some of those conversations like, or who did you include in those conversations? What were some of those key things that you had to think about and really make sure that you addressed in the financial piece of your planning?
Actually, to begin with, when we started selling off offices one by one, we began with 1 year's gross of income and then go up or down from there, depending on, how much they were going to be able to work in the off season and that type of thing. But that was our starting point, was 1 year's gross of income.
As the selling price. And so we believed that that was what we were entitled to. We ought to be able getting out of the business, but that wasn't the kind of offer that we were getting from these brokers and the people that they were working with, because it was just too spread out of an operation. And so we believed we could do that if we sold them one at a time and did the seller financing. And so that became our strategy.
And so you evaluated both different offer structures that the brokers are giving you versus what this management buyout or a seller carry would be for over a 5-year period. And you found that the seller carry actually gave you more dollars back into your pocket.
Absolutely. Yeah.
Interesting. I think it's super fascinating. And talk to us personally, like on the personal side of your financial planning, what were some of those key things that you had to make sure that you balanced between the selling price and your personal finances for post-exit? Because I'm bringing that question up because specifically there's a lot of, especially spouses, can be very concerned with the financial security after either the husband or the husband-wife team, after the business is no longer in the picture, providing them the usual piggy bank, right, that they've been used to. How did you guys approach that topic with each other? And what were some of those personal financial conversations like that could potentially help other couples have the same conversation in a productive manner?
Well, I think one of the things that was unique to us is that we were both involved with business, and both of us qualified pretty much to do most of what we were doing. I wasn't as qualified with the accounting. She wasn't licensed for the securities, but the overall tax operation, either one of us could do that. So this was a part of our consideration. But we were also looking at, what we find with so many owners is they're looking each year just at the immediate tax situation. How can I pay the least amount of taxes now, rather than looking at the long range? And we were trying to look at the long range to say, okay, where do you want to be down the road there? Because we're going to be at the point that someday we're going to be collecting Social Security, we got Medicare, all this kind of stuff. How are we going to have enough in there if we are continually always looking at how to pay the least amount of taxes now and concluding we won't? And so we're going to have to do something to provide for that. And so the formula that Sharon came up with, we worked with on this, was let's deposit for our future down the road. And so we had set relatively high salaries, more than really the business could afford to pay. And so we would draw those salaries, we would pay the taxes on it, but we would then loan funds back to the company, and those became shareholder loans to the company that would be able to be drawn out at one day tax-free, because we'd already paid the tax on that money. And so we were banking money in there in the loan account that we could draw out later. But we were also, by the higher salaries, we were making sure we had put in enough into Social Security and Medicare that we could draw as high as we could on Social Security when we were finally ready to draw that. And so we were looking ahead to make certain that down the road, we weren't going to come up short. And that's where I see so many business owners not even thinking in those terms. It's all about, how can I save taxes I'm paying now? But you're going to need to have an investment in the future down there, and you're going to come up short if you haven't thought about this.
Well, so many people we come across even now that have small businesses, not humongous things like we had, but they have small businesses and they work as hard as they can to come up with zero income. Well, zero income for example, Schedule C on a tax return does not put one dime into your future Social Security. But so many, especially middle-aged people, 40s and 50s, I come across, have no pension plan, haven't put anything into retirement, haven't put a whole lot into Social Security, and then they come to take Social Security and it's not there. And they're only getting, a minimum amount. It just works if you own your own company to do this loan thing where the company is actually paying the taxes and you're paying the taxes, your part, but the net amount of the salary or part of it goes into the loan account to be taken later when you are not working and are collecting Social Security.
So you were using it kind of like a line of credit, like a personal line of credit back to the company. Is that interesting? And who came up with this idea? I was going to say, it sounds like a Sharon.
She's a brazen
So you looked at your entire plan and your financial strategy and you were like, okay, what's most important is financial security long term. And you were saying, okay, what's going to be the best way of doing that? We're going to take out more money. Yes, we're going to pay taxes today, but we're investing in a future later. You're going to have more to draw on from Social Security because it's what's your Social Security based off of? Like, what's that? How do they base that number, the deposit after you start collecting? Is it 7 years? Is it 7 years? Your highest 7 years?
No, absolutely not. It's your highest 35 years.
Oh, highest 35.
And so if you had a period of time where you weren't working or you were making zero income and not paying in, that goes into the average.
Oh, wow.
It's a 35-year average when you retire.
She's talking about it being your net income taxable because you've taken all these deductions and you're looking more and more deductions, and some that maybe even suspect to be able to get that down there. But again, that is not going to serve them because they've got then all these blanks on their Social Security record of what they had for income for those years.
And if you want to know what that is, all you have to do is go on SSA.gov and they will actually send you either digitally or in the mail, a record of your entire Social Security record history.
Interesting. I did not know that. That's definitely something I learned today. I appreciate that insight and clarity.
Because they used to send those statements out in October every year, but a lot of years ago, they quit doing that. And so you really don't get anything. You don't know what your history is actually unless you request it from them.
Interesting. And so when you're giving a loan, you're giving an active line of credit to your business. How did that work when you were selling piecemeal of your business off to these different call them, quasi franchises? And how did you, because I could see like the rebuttal or somebody's saying, well, that's a lot of risk. You're putting more money at the table. You're putting more money in the risk and because now it's debt. But how did you get that money back tax free as you're piecemealing it?
We had to keep the business going. You had the corporation. We're not selling the corporation. We're just selling off assets, client lists, name it, business in these locations. And so we maintain control of the corporation, and we still have the corporation operational. And that's the key. You're not going to sell off what, and this is the danger. A person winds up, they get a big offer. It's attractive. We're going to, just sell the business now. The C corporation, they don't realize when they sell that, all that they had in retained earnings, loans, everything else, they just, they gave it up. Make sure that they get everything out of the corporation that they have invested there and have assets in there to draw out of it. Because you can take those retained earnings as dividends. You can pull out the loans as tax-free income, but you got to do that before you sell it. You sell it, you just get the whole package.
It's all gone.
Interesting. Super interesting. And so your strategy, you always knew you weren't going to close the entire business down.
Right.
You were just selling individual assets inside the business.
Maintain the corporate.
Maintain the corporation. When your business bank account at the end, when you are ready to maybe wind down or something like that, you're going to pay yourselves back and have a nice tax-free lump sum. And that was part of your planning strategy process. Like, how do you get the most amount of lump sum out of the business without having to pay taxes on it?
And with us, it really wasn't a lump sum. We wanted to draw on year by year and income out of there, but being tax free as much as possible. And so this became an ongoing sustaining thing for us to have an income that we weren't having to list our tax return as a salary or something else out of the business. We were simply paying ourselves back for the loans we put in there.
Very interesting. And let's talk a little bit about what are those. You said each of those were 12 agreements or 11 or 10 or however many part of the business you sold. They were all had tweaks and very unique, right, to who was taking the business. Let's talk about the commonality between all of the agreements. What were some of those things that were common amongst everything? And then let's talk about what were some of those unique pieces that need to be inside of each of those deals to make the deal work for the other person, the counterparty. Let's start with what was common.
The commonality was we were selling tax businesses. We weren't selling off the accounting in most of these cases or securities part of it. We were tax business. The other thing that was common was our proposal was a 5-year seller finance proposition with a consulting involved with it. The other thing that was common was we didn't require a down with them. This was basically divided out over a 5-year period, and a fifth of it each year they were paying in to us. So that was the common part of it. Other part, the common was that the client lists all became theirs. And we were not going to be out soliciting clients in those areas.
So we have had these clients that we have now are longtime clients. They're around
that's kind of
the country, actually.
You guys can reach out, but don't
originally
give me
we may have done their work in Arizona, but now they've moved somewhere else or whatever. And so we have clients all around, and we prepare all those state returns wherever they live. We go in and do the research and prepare those returns. But most of our client lists now are not Prescott people that have, a few of them are, but most of them are not. Most of them are clients that we have had ever since Springerville, which was 1990. And that's a long time ago, like 35 years. And some of them, and they die off occasionally because they're our age or older, or they have a disease or whatever and pass away.
But in many cases, we wind up then doing the kids and the grandkids.
Yeah.
It's a multi-generational kind of thing that we keep working with these clients.
That's awesome. And so let's talk now about what were some of those unique pieces that need to be part of each of those different deals that helped the counterparty, or maybe reduced the counterparty risk, or were needed to be in those clauses. Like, what were some of those unique things?
I think probably the most unique thing was who was buying it, what their particular abilities were, what their particular situation was, and how we would have to adapt that with them if we needed to make contacts, get things for them that they didn't have the capacity to do. Just tailoring it to each of their individual situations. And like this one with our largest office out there that wasn't feeling that she was confident to do this, rather just still work for us, and just basically walk her through different possibilities until we found something that would work on this. And but they were all, tax clients, and you're working with that commonality. But there were some situations too where they felt like they were not capable of handling this complex of a thing. And they would ask, would you continue to work with this particular client? Because I really don't feel I can do this. And so we would agree to do that. So we picked up some of those that we agreed to continue on with and serve as a condition of selling it to them.
Interesting. So you had each of them said, well, this person is really complex and I don't really feel comfortable taking this one, so why don't you guys keep this client?
They'll call me because they know that's my specialty and say, okay, can you do this client? And so we contact the client and set up they either come to our office or I just talk to them on the phone and do it that way.
And sometimes they fit into what we can do and want to do, and sometimes they don't. And we'll suggest they go someplace else because they probably would be better served by somebody over in their area who has that particular area of expertise. And we decide this isn't really a situation we want to work with. Others, we do work with them.
Interesting. And what were some of the things in this journey and the entire journey overall? What were some things that went really well? And then what were some of those lessons learned about selling your business that you would say, hey, I think we could do that a little bit better?
I think the things that went really well were the relationships we had with the manager owners that took very seriously the fact that they were going to pay us and they were going to do everything honestly and ethically. And we had a couple that were disappointments that, and we wound up actually writing off one or two of those that it was just a situation that we didn't want to continue to have to deal with them. And they were doing some things we didn't approve of. And so we just wound up giving them a 1099 and saying, okay, this is the way we're going to do this. And so they had to pay tax on that 1099 and we were able to write it off then.
Interesting. So that you still, even in the process, there was still, some people let you down, but most people actually felt, went through, right? And most of the people were good, honest people.
Yeah. And we've continued, so we built relationships, and so they're our friends, and we've been through thick and thin, through the things that have gone on in their lives and celebrating good things and grieving with them during the hard times and everything. So we really try to continue to cultivate that.
That's awesome. So it's both what went well, and then it's also what surprised you. Mm-hmm. So it's kind of a little bit of both.
Yeah. You can't always predict what's going to happen when you're no longer in charge. So sometimes it works well and sometimes it doesn't. You get disappointed in what people do and they get caught up in something that they shouldn't be in. And so that's when you want to cut them loose and say, we're not going to do this anymore.
And that's when you need a really good contract. That's when you got to make sure your contracts are all up front, make sure everything's understood. Did you guys work with an attorney to help with any of this, or you guys just did all this yourself?
I did the contracts.
You did the contract.
Well, she has a master's in business law, so.
Okay. So it's not like you just, I'm going to decide to do it. You didn't chat GPT it.
And most attorneys don't really understand that much about taxes and tax businesses and stuff. So I'd rather trust Sharon.
That makes sense. I'd rather trust Sharon too. Yeah. I appreciate you sharing this journey with us because I think this is super fascinating. I think you guys have a very unique story and the way you guys have approached this has been very successful. And I think my goal is I hope more people get encouragement from hearing these type of success stories, right? But let's talk about some of those generic business stories real quick. And we got a few minutes left, but I want to talk what are the top 3 mistakes that you see small business owners making with tax strategy when it comes to exit succession strategy? What are the top 3 mistakes?
Lack of planning.
Well, and it depends on the entity. If they have a C corporation, again, if they've made the mistake of putting a building in there, then that is going to be a problem because they're going to have a double taxation situation. So if all possible, they need to delay getting out long enough that they get that building out of there. They can, if it's a Z corporation, as the shareholder, they can buy it at the adjusted basis so that you don't have a gain that is going to be taxed 2 ways. There's different strategies there, but that's one of the things, having that building in a C corporation. Outside of a C corporation, I see one of the biggest mistakes that is made. Let's say they're a sole proprietor. They have the building and everything. And so they're going to have their son or daughter-in-law take over the business and go on. It's fine to transfer the business to the son or daughter-in-law, but do not transfer the building. Because if you transfer the building, the ownership of the building, you wind up where they have to then have your basis, whatever you paid for it. If they wind up then selling it down the road, they're going to pay taxes on all that gain from when you bought it to when they are selling it. Whereas if you don't transfer the ownership, but you will it to them, your will, your trust, then they get the stepped up basis at the time of your death. So the only tax you're going to pay is for whatever gain it's had since that stepped up basis, fair market value at the time of your death. So that's one of the big mistakes I see people doing. They wind up transferring ownership of property, buildings like this, where then they have a huge tax down the road when they go to sell it. So better to put it into the will or the trust and have them gain that way as part of the deals or turning the business over to the kids. The other thing that we see happening is that there are these things that wind up in a C corporation when they may get a buyer down here and they don't realize what they've got in the corporation as far as retained earnings or loans to the here or NOLs, net operating losses. If they just sell those of the business, all that's gone. It doesn't go with the new owner and you can't get any value out of it. So this is where, again, we need to be talking. They need to be talking to somebody like us that can help them evaluate and see what do you have in your business still you need to get out before you sell it. So that lack of planning and really know where you are and what you're doing and what you're provided for the future then is something that we need to talk.
Yeah, absolutely. That was a few things I think were specifically related to a C corp. But what are some of the things and mistakes that people with LLCs or maybe LLCs taxed as S corps make that are avoidable with just a little bit of planning?
One of the major things with somebody that's being taxed as an S corporation is they have to pay themselves a salary, not $5,000. A salary commensurate with the job, the management or whatever they're doing with the company. They have to take a salary, and that is a huge, huge audit issue with the IRS. And they are constantly increasing the percentage of S corps that they're auditing, mostly because they don't take a salary or don't take enough salary.
And the thing that a person doesn't realize is that these audits generally, and there's a 3-year statute of limitation on the federal, there's a 4-year on the state. And both the federal and the state generally tend to wait until the last few months of that statute of limitation to come after you. So maybe you're selling the business back here, but you still have that obligation tax-wise from when you owned it back there that they haven't audited you yet.
Oh, wow.
And so, like Sharon is saying, if they haven't taken these salaries like they're supposed to, you could wind up with an immense amount that is owed to the IRS, even after you said, well, I've closed the business.
The IRS doesn't care.
You need to understand what are the requirements of the entity. And that's one of the requirements of the S corporation. And again, the transfer of property, this is particularly outside of a C corporation. This would be for LLCs, sole proprietors, S corp, the buildings owned by the individual.
That's fascinating. And super helpful for people to start getting a sense for what they need to start thinking about when they're approaching, when they even think about trying to exit their business. It's like, well, a lot of this stuff takes time. It takes time to plan. It takes time to move assets. It takes time and resources to be able to adjust or pivot or change or kind of like move in a different direction. And like you're saying, it was 4 years is the statute of limitation for
4 years for the state, is 3 years for IRS.
4 and 3. And that's why a lot of businesses are when you go to sell, they look for 5 years of return so they can see, if there's any major problems that are going to be coming, make sure that they don't have any blind spots, right? They're not going to get blindsided by a IRS knock on the door after they acquire your business. So yeah, I think knowing what your 5 years, look back 5 years, if you have 5 years to plan, I think that sounds like it's the way to go.
What we find is that people, they're all involved in doing the business of the day. So many of them don't even really understand what they've got in their business. They don't understand what the rules are, and suddenly they trip over the tripwire and they're in deep trouble. And so, again, if you're thinking about exiting your business down the road, you need to go talk to somebody that can help you figure out exactly where you are now, what you have, and what you may need to get out before you sell that. And so that's what we see so often. People even have been set up by attorneys and everybody on some of these things. They maybe added trust, but they've never really funded the trust, never put the things into the trust. So the trust is basically worthless. They paid all this money for it. And so these are things that we need to be looking at with people to see, well, is your house in order? What do you really have here before you start talking about selling it off and then suddenly realizing you got a can of worms?
Absolutely. Absolutely. You got to know where you're at to know where you want to, and know where you want to go, and then figure out what the gap is and how to move forward. So I think this has been, I could stay here probably for another few hours and just continue to talk, but I know we're kind of running out of time. But if you had to boil all of your experience through your business from genesis to exiting, if you had to boil it all down into a first principle, what is the main thing that you would say or want to pass on to somebody else trying to maybe walk in your footprints? What is the first principle that they should use to guide them through this journey?
I think the most important thing is business ethics. Make certain that you are committed to quality, delivering everything that you promise, keeping your word, because that is so very, very important to the success of any business, and that you develop that level of trust and the relationships with your customers, your clients. And so I think that's really the most important element. That's how we built our business.
That's amazing.
Well, and being honest, honesty is just a real big issue with accounting clients. I had one client that I didn't have very long because I discovered that she was taking the cash out of the business home and saving to make a down payment on a house with the cash out of the business. She wasn't reporting it to the IRS or anything else. She was just taking the cash home and only paying tax on credit card income and things like that. And once I discovered that, I was done.
But we see this going on in so many businesses. They're not trustworthy. And
they pay people under the table.
Their act cleaned up. When we bought our first, the franchise office, we were surprised to discover that the owner had been breaking off about $25,000 cash a year that didn't get reported to the IRS. And not only that, we discovered there were two sets of file cabinets in the back of the office, one that was marked for the IRS and one for bank. So we had to let the people in the town understand we only keep one set of tax returns.
We don't do business that way.
And we soon became known by the banks as the tax business
the go-to
that would really give an honest answer as to what was going on with the client, because there was this double standard that kind of had developed in that culture there. And so we see this in so many businesses. The lack of ethics is just, I think, a serious stumbling block for businesses.
I think that's powerful. I think that's super powerful. Sometimes it's very easy to get sucked into, well, everybody's doing it. This is what everybody else is doing. So if you want to do business, this is how you got to do it. But I think that's super powerful to remind people that, no, honesty is the best policy. Thank you, Dr. Art and Sharon. Thank you so much for your time today. I think this has been a great episode. I know I always learn a ton from every episode we have, but this one I've learned a lot, and I just want to say thank you very much for your time and your continued support. I know you guys were one of our featured headline speakers at our live event we just had a couple weekends ago, and you guys were fantastic on stage then, and this is I think a good follow-up to that 100%. So with that, I will make sure that those that can reach out to you, we're going to put them on, put you a link to your website and to wherever you want to direct people. But where can people find you in general? What can people find you?
It's best really to just call our
phone.
Our website is in progress. We don't have the live website at this point. There's so many headaches with that. So they can call our business number, which is 928-277-4988.
Perfect. And we'll make sure it's in the description of the video so that people can reach out to you if they have questions that they need answers with. Mm-hmm. And again, thank you so much for your time. With that, thank you everybody for your time and attention, and we will see you next time.